Welcome to this ICAP capstone project on the basics of algorithmic trading using the new MIN platform. This first lesson covers financial markets and data. We'll begin by looking at how financial markets work. Imagine a simple scenario: the trading of a single company's stock. Buyers and sellers interact on a stock exchange, with prices fluctuating based on supply and demand. A trade occurs when a buyer and seller agree on a price. The price of the stock reflects this ongoing interaction between buyers and sellers. For example, consider a single stock or any tradable instrument. A buyer places a buy order expressing their willingness to buy at a price, say 95. Next, a seller places a sell order asking for a price of 103 for the stock. Another sell order comes in at 101, then a buy order at 98. Finally, there is a buyer offering 100 and a seller asking 100. These get matched by the exchange, creating a trade at the price 100. The price of the stock is therefore 100, as has been discovered by the process of matching buyers and sellers. Let's continue the example further. The buyer at 95 thinks the stock is overpriced and cancels their order. Another buyer comes in at 99. A third buyer comes in at 101 and gets matched to the waiting sell order at 101, resulting in a trade at 101. The price of the stock, which is merely the last price at which the stock was traded, therefore moves up to 101. Now let's delve into the types of market data available to us. We'll focus on three key data sources: trade data, order book data, and OHLCV data. Trade data records the timestamp, symbol, type, limit, market, or trade, and price of each transaction. We have already seen limit orders, that is, offers to buy or sell a stock at a predetermined price, which may get matched or may remain waiting, and can be cancelled by the buyer or seller if they feel it's too far away from where the stock is trading. Similarly, trades are merely the matched orders, determining the price of the stock at any moment in time. Market orders, on the other hand, are offers to buy or sell the stock at the best price on offer. In other words, a market sell order gets matched to the highest pending buy order, and a market buy order to the lowest pending sell order. The order book provides a snapshot of outstanding buy and sell orders at various prices, including their quantities. Finally, OHLCV data, which stands for open, high, low, close, and volume, summarizes price movements over a specific time interval, like a 5-minute or 1-second candle. Let's examine OHLCV data more closely. Each candle represents price action over a chosen time period. The open represents the price at the beginning of the period, and close is the price at the end of the period. A green candle indicates a closing price higher than the opening price, an upward trend, while a red candle shows a closing price lower than the opening price, a downward trend. Similarly, high is the highest price reached, low the lowest price traded in the period. OHLCV data isn't just about individual candles, it's also useful as cross-sectional data, allowing us to compare OHLCV data across multiple stocks simultaneously. Further, we can derive technical indicators from OHLCV data. For example, moving averages, calculated by averaging closing prices over a specified number of candles, help identify trends. Crossing of short and long-term moving averages often signals trend reversals. Other important technical indicators include Bollinger Bands, which measure volatility. Another indicator is the Relative Strength Index, RSI, which gauges whether a stock might be overbought or oversold, for example, in an oscillating market with no clear upward or downward trend. The stock price tends to revert to a mean price, and RSI indicates that such as trend reversal may be imminent. In the next section, we'll introduce the new MIN platform for developing and testing trading strategies.